Hello, today is Wednesday, September 3rd, 2025. In today's video, we're going to be looking at the Day Trading GPS SPX Daily Key Levels Indicator for TradingView and using that indicator and its strategy to trade SPX 0 DTE call and put options. Okay, so the way this indicator works is that the levels that you see on the screen here when you have it on the SPX CBOE index will appear on your screen at the market open at 9:30. If you want a preview of the levels prior to 9:30, then the levels can also be shown on a table on the SPX 500 8-cap CFD. So that is a secondary symbol that this indicator will work on. If you have it on that symbol, then you will also see the SPX CBOE index key levels at 9 a.m. So that will give you a 30-minute head start on planning out your trades for the coming session that opens 30 minutes later at 9:30 a.m. Okay, so if you have your chart on the SPX CBOE index at 9:30, you will have the levels here on your chart. We have the main levels, which the main one is the SPX bull bear key price level. That is what the indicator is determined is going to be the key bull bear pivot for this session. And above that would be your take profit levels of R1 through R6 on long plays, and below that is S1 through S6, which would be your take profit levels for put option plays on bearish plays below the bull bear key price level. The midpoints here act as gauges for continuing momentum, and they are also used for stop losses depending on whether you're taking a bullish play or a bearish play. The midpoint levels are optional to turn on, but it's highly advisable that you do use them. The line labels here can be set separately, so what that means is that you can make the labels for the main levels larger or smaller, and you can independently make the midpoint labels larger and smaller. So as you can see here, we have two different sizes. These are on large, the main levels. The midpoint levels are on the normal size. Also, there's an optional table here which you can turn on, which will also show you the levels. This can be helpful if you're zooming in, as we've done here, from R2 down to S3, but we also want to know what the reference points are for the levels outside of that. Okay, so here in today's session we had a gap up. This is the prior day session with the close here. As you can see, we had a gap up. Price opened above the bull bear key price level but moved below it and also closed below it. That is your entry signal for a bearish play, and in this case that would be a put option, the 0 DTE 6440 put. The reason for the 6440 strike is that that is the closest strike to the bull bear key price level today, which is 6442.14. Your standard stop loss on a bearish entry triggered from the bull bear key price level would be your standard SL is the first midpoint level above the BBKPL. That would be your midpoint level here, the mid BBKPL R1 6448.88. If you prefer for your risk profile to use a tight stop loss, the tight stop loss is the first quarter level above the bull bear key price level, which is 6445.51. Now in this particular version that is out now, the quarter levels are not automatically plotted, but you can easily manually plot them by just simply taking the midpoint level here and the bull bear key price level, adding them together, dividing it by 2. We will be coming out with an updated version of this indicator and if you purchase the indicator now, you will receive any updates in the future at no additional charge, and you will also be locked into the current price. When the enhancements come out in the next version, which one of them will be the auto plotting of the quarter levels, the price will be going up. Some other enhancements that will be coming out in the next version of this indicator, which will be released shortly, is it will also have statistics, which will show you the statistics for various bullish and bearish trades taken, which can be back tested. Okay, so moving on here, so this is your entry here. And we'll be showing you the thinkorswim option charts on all of these option prices that are listed here, so you can see that and have them validated with the timestamps. So we'll do that later on in the video, but for right now, the high price of the 64.40 put option here, the intra-candle was 14.20, the low was 11.30, and the close was 13.40. So you're generally going to be buying these on the close to make sure that it does in fact close below the bull bear key price level in this particular instance. If instead it had closed above, then you would be looking at a call option instead. But in this case, it did close below, and you also have to keep in mind that we have a significant gap up, and there is a tendency to have partial or full gap fills on days like today. So in this case, that's another reason for the bearish play, on top of having the close below the bull bear key price level. So your buy on close is $13.40 a contract. That was the closing price of this 2-minute candle. As we said, the standard SL is the first midpoint here above the bull bear key price level on this bearish play, or if you prefer using a tight SL, it would be here. As you can see here, we did get some price movement down to the S1 level at 10:12 a.m. The 64.40 put was now $16 on the candle close. So we did have a small profit here of $260 a contract right here. Generally at this point here, when it's moved down one level, you can choose to adjust your stop loss if you would like to move it down to the next level, which in either case here would be moving it down to the bull bear key price level. However, in this video, we're going to assume that you did not do that because you were waiting for price to move down to either 1.5 levels below, which would be this midpoint here, or 2 levels below here, so you could close out your trades. So in this case, we did have a stop out. If you at 10:36 a.m. here, we had a stop out on the tight SL on this touch here on this particular candle. The stop out price was $7, which is the low of this candle. If you used a tight SL instead of using the standard SL, then the loss here would be $640 a contract, and you get that by taking the buy price of $13.40 minus the stop out price of $7. If you use the standard stop level, which is the midpoint here, then at 10:42 a.m. you would have been stopped out here on this candle. Stop out price is the low of this candle, which is $4.80. So if you use the standard SL, then your loss here is $860 per contract. However, at 8:24 a.m. we had another move down and cross below the bull bear key price level here. At 11:24 a.m. candle, cross below, close below BBKPL. The buy price here intra-candle was anywhere from 5.30 to 7.30. However, on the candle close, it was $7.10. So that's your buy price on the close of this candle as it closed below the bull bear key price level at $7.10 per contract. You're using the same stop losses as you did before, because this is triggered from this particular level here, the bull bear key price level. So your tight is the tightest sell is the first quarter level above, as we mentioned before. Your standard SL is the first midpoint level above. As you can see here, in either case, it did not come close to either one of the stop losses this time around. And at 12:48 p.m., roughly an hour and a half later, SPX hits the S1 level. The 64.40 put is now $14.30 on the candle close here. So you have a current profit of $720 per contract. That's taken from the buy price of $710 on this close and against the closing price here, which is $14.30. Here at 1:44 p.m., SPX hits the mid S1, S2 level. This would be your first opportunity here if you wanted to close out. Generally, when using this indicator, you want to close out trades from 1.5 levels to 2 levels or more. So at this point, at 1:44 p.m., the 64.40 put is now $20.96 on the candle close. The profit is $1,386 per contract. So now we're in profit for the day, regardless of which one we were stopped out on earlier. At 2:38 p.m., SPX is nearing the S2 level. It comes up just a couple of points short here. At this point, the 64.40 put is now $24.10 on the candle close, and if you held on to the contract until this point, the profit would be $1,700 per contract. Keep in mind that at any of these level hits here, as we mentioned earlier, that when it hits the S1 level, then you can consider moving your stop down to the next level here, which would have been the bull bear key price level, and in this case it did not hit that. So if you moved it down, those were never in jeopardy if you did move it down. Okay, so right here we're past 2 o'clock. This is the time of the lotto window, which starts at 2 p.m. and runs to the 4 p.m. close. Generally, you want to enter any lotto plays before 3:40 to 3:45 p.m. hits. So what that means is that your real window for entering a trade would be starting at 2 p.m. and up to 3:40 to 3:45. The general lotto play rule is to only use up to 10% of the previous session net profits on any lotto play you're considering entering, as there is a high chance they may go to 0, but can also return 4x to 10x, and in some cases, in some sessions, we've seen as much as 20x to 40x, depending on how extreme the late day moves can be. So here, if you wanted to take up to 10% of your previous session net profits, so here, depending on how many contracts you traded, would determine what that 10% figure would be. So remember here, your profit is $1,386 per contract here, which would be your first opportunity, because this is a 1.5 level move down, to close out your trade. And in the case of, let's say you had 10 contracts, then you would have a profit of $13,860 versus a loss back here on 10 contracts of $8,600. So your profit on the day here is approximately $5,000. In that case, you would only want to use up to 10% of your previous session net profits for any lotto plays you may want to consider entering here. So if you had $5,000 in profits, then you would only want to look at considering using up to 10% of that, which would be $500 towards any lotto place. If your profits were your net profits after this loss here and the profit here was $2,500, then you would only want to use up to 10% of that, which would be $250. And if you, let's say you were trading 2 contracts, in this case here at 1,386 minus 860, you basically have approximately $1,000 here, so that would only give you up to $100 in lotto plays. Okay, and the reason for that is because you don't want to jeopardize profits that you made earlier if you're going to jump into a lotto play later, because there is a chance that they will go to zero. That's why they're called lotto plays, but they can return 4x to 10x, and many times 15 to 20x, and sometimes as much as 40x or more. But they also have a good chance to go to zero, so you never want to put in jeopardy more than 10% of any previous session net profits. If you don't have enough in previous session net profits to buy a lotto play, then you would just not consider them at all. However, if you did, here later in the session, after moving sideways at the 3:30 p.m. candle here, we have a pop-up from this mid S1, S2 level, and this would be lotto play number 1 entry to consider. A 64.30 call, because you'd be buying the next level up here. 64.2866 is the next level up here on a call option. So the closest strike is 64.30. The buy on the close of this candle here was $1.05. So that would cost you $105 per contract. So again, if you had, say, $1,000 in profits, then even though this is slightly over $1, it's $105. You could buy one of those here. If you had $5,000 in earlier profits and you were taking 10%, then you could consider buying up to 5. However, if you did not enter here, another entry would be on this break above the S1 level here, because we're looking for eventually is a move back up to test this level here, because it was tested several times earlier in the session, and we're looking for a possible close to go back up to at least this bull bear key price level. So here on this close above here at 3:38 p.m., again it would be the 64.30 call, and at this point the 64.30 call was $2.65 on the close of this candle here at 3:38 p.m. As you can see here, we did have a move up to the bull bear key price level here at 3:54 p.m. It hits that level, and the 64.30 lotto call on the close of this candle here at 3:54 p.m. is $12.55. So if you used lotto entry 1 here and bought for $1.05, your profit is $1,150 per contract. If you instead use lotto entry 2 here on this break above the S1, then your profit is $990 per contract. And as you can see here, if you held into the close, we had a move almost up to BBKPLR1, and of course that, as we'll see in the thinkorswim chart here in a second, this shot up past $16 here. Okay, so this brings up another important point about this indicator, is that your entries are not limited to just entries surrounding the bull bear key price level. The reason why the bull bear key price level is so important is at the beginning of the session and the morning session, this is going to be your most important level, the bull bear key price level pivot. And that's going to determine your bullish or bearish entry. However, and even though these levels, as we mentioned before, are take profit levels from entries triggered off of the bull bear key price level, On bearish ones, these are your take profit levels below, and on bullish entries, these are your take profit levels above. However, in many sessions, you will see price move down much more sharply than it did here, and you would get an exit early on in the session, and then you'll get a sideways movement, and then you'll get a break above a level. So later on in the session, you can use, even though these are take profit levels off of entries off of this trigger here, later on in the session, these levels can become entry levels for bullish or bearish plays. So on the levels below, you're generally looking at bullish plays later on in the session, and that would be based on price action having successful retest and close above these levels. So you might see a pop above, a retrace, a retest, and then a move back above. And that can be an entry level for another call option, either at the money call option at that particular level, or using an out of the money call option, either the half level above or the full level above. In those cases, your stop losses are going to be the same methodology. So you would use on this level here, if let's say that you had a bullish entry from this level here later on the session on a successful retest and close above, your standard stop loss would be the first midpoint level below, and your tight stop loss would be the first quarter level below. On the other hand, if price had shot up here and on a bullish play at the beginning of the session, and we'd taken our profits and we were looking at price action, and we were seeing the price action was becoming weak, and that price was beginning to move back down from one of these R levels above, and we had a successful retest and close back down, and you wanted to take a bearish play for a move back down to say here, or back to the bull bear key price level, or even below it, then the same methodology would be for your stop loss levels here. So let's say as an example here on the R2 level, even though we don't have the mid R2 R3 level here, you would use the standard stop loss here, which would be the mid R2 first midpoint above the R2 level, which would be mid R2 R3, and if you had a tight stop loss, it would be the first quarter level above R2. If you were instead taking a bearish play from here on the R1 level later in the session, then your standard stop loss would be mid R1 R2, and your tight stop loss would be the quarter level above, which again, for right now, you would have to manually do the quarter level by just adding the two levels together and dividing by 2. As I said earlier, we will be coming out with an update to this indicator very soon that will include, among other enhancements, the auto plotting of the quarter levels, and it will also include statistics on trades taken from levels based on risk reward ratios as well as level movements. So that will be coming out soon, and that will also include some other enhancements besides the quarter levels and the statistics. When that version comes out, it will be more expensive than the current version. However, everyone that purchases this indicator now at the current price will get the updates to this indicator with the enhancements at no additional charge. All of our indicators are sold on a lifetime access basis, which means that as we come out with updates to it later on and enhancements, you will receive those updates at no additional charge. However, as we add more enhancements, new customers will be paying more for the indicator than previous customers. So it's best to, if you have an interest in purchasing this indicator, to go ahead and get it at today's price, as prices will only be going up in the future as we come out with more and more enhancements. Also, in return for taking the time to watch this video today, if you will email us at daytradinggps@gmail.com, you can request a promo code to use to purchase the indicator. And just send us an email to daytradinggps@gmail.com to request the promo code for the SPX Daily Key Levels Indicator, and we will send you a promo code that will give you a discount. Okay, so right now what we're going to do is we're going to look at the thicker swim charts. Okay, so first off, the 6440 put. So if you remember, we had the 930 candle here, which we bought on the close of $13.40 per contract. So this is a 2-minute chart again. So this is the open, high, low, and close. So buying on the close here of the 9:30 a.m. 2-minute candle for the 6440 put at $13.40 per contract. Here we have the move where it hits S1 level. So at this point at 10:12 a.m. the close was $16. So at this point you had a $260 profit. However, we did get stopped out. So at 10:36 a.m. here you have the tight SL getting stopped out. And here you see the close of that candle, $7.65. However, as we did on the chart, we're using the low of this candle for the stop out, which is 7. Same thing here, using the low for the 10:42 a.m. candle. This is where we got stopped at on the standard SL. As you can see here, the open, high, low, and close. However, we're using the low, as we did on the chart, of $4.80. Here is the entry number 2 on the 11:24 a.m. candle. The close of that candle is $7.10, so that's our entry price when price cross below and close below the bull bear key price level again. Here at 12:48, this is where SPX hits the S1 level, and the close of this candle is $14.30, so we had an entry at $7.10, and now we are up to $14.30. Here at 1:44 p.m. is where SPX hits the mid S1, S2 level. The close of this candle, after hitting a high of 23 on the close of this candle, is $20.96. This would be your first opportunity here to close out all of your trades, because at this point we had a 1.5 level move. At 2:38 p.m. that's when SPX was just a few points shy of the S2 level before it began its rebound. Here we had a high of $24.10, which happens to be the close of this candle too, at $24.10. So you would have exited here or exited here. Now we'll take a look at the 6430 lotto call. So if you remember, we had entry number 1 at 3:30 p.m. on the pop above the mid S1, S2 level. At this point, the open was 70 cents, the high was $1.10, the low was 65 cents. The close of this candle was $1.05, you'd be buying on the close of the candle, so that would be $1.05 per contract, which is $105 per contract. If you did not get in here, the next entry, the alternative entry, would have been the close above S1, which happened at 3:38 p.m. The close of that candle, the price was $2.65. You would have bought on the close of the candle, so that's $2.65 a contract, which is $265 per contract. Here at 3:54 p.m., this is the candle where SPX hit the bull bear key price level. Again, at 3:54 p.m., it hit a high of $13.70. It closed that candle at 12:55, so you'd be getting out at the close of the candle, and that's what gives you your profit depending on your entry here. Or your entry here. Okay, so as you can see here at the end of the session, we did get a spike above, where it spiked almost right to mid KPL R1, and this particular call option, if you held it into the close, you would have gotten out at $16.60. As you can see here, though, there is a lot of volatility at the end of the day and movement in these options. So the most prudent thing to do is just to get out when it hits the bull bear key price level. However, if you're just holding into the close just to see what happens, since there's a lot of play, then on this particular day you would have been rewarded with a spike above, and you would have been out at $16.60. Okay, just bringing this back in again. That's just what we went through, all these different entries. Here's the stop outs. Here's the re-entry again. Here's where it hits S1, mid S1, S2, nearing S2. Here was the first lotto entry here. The second opportunity for lotto entry was here. Here was where it hits the bull bear key price level here at 3:54, and here's the spike up at the end of the day. Okay, well, thank you for taking the time to watch this video, and as I mentioned earlier, if you send us an email to daytradinggps@gmail.com, we will send you and you request the promo code for the SPX Daily Key Levels Indicator. We'll send you a discount promo code you can use on your purchase of the indicator. And as I also stated, all of the indicators are sold on a lifetime access basis, which means that you are entitled to receive any improvements or enhanced versions that come out later as time goes on, even when those new versions are more expensive. You're grandfathered in at whatever price you paid, and you're entitled to receive the enhanced, updated versions as they come out later with more and more features at no additional charge. Alright, thank you again, and we wish you prosperity in all your future trading endeavors. Thank you.